There is a pattern in monetary history that almost nobody sees until it's too late. First, a metal is money. It is trusted, carried in pockets, saved in coins, used to settle debts. Then, slowly and quietly, governments strip it out of the system, replace it with paper promises, and tell you nothing important has changed. Next, industry discovers that same metal is irreplaceable. It gets soldered into circuit boards, baked into solar panels, woven into the nervous system of the modern world. And finally, one day, the financial system and the physical world collide. The paper claims say one thing, the warehouses say another, shelves empty, premiums explode, coins are rationed, futures markets behave like they're drunk. And a boring metal that nobody cared about yesterday suddenly becomes something else entirely. Unobtainable. That's the silver lockdown pattern. Not a government decree, not a single law, but a slow-motion clamp, monetary, industrial, and financial, that leaves ordinary people locked out of real metal just when they need it most. Right now, in the mid-2020s, silver is moving into the final stages of that pattern. The headlines still talk about gold, about tech stocks, about inflation prints and interest rates. But beneath that noise, silver is quietly entering its own version of a global lockdown. And like every real lockdown, by the time it's obvious, it's already too late to prepare. This is the story of how silver was removed from your money, embedded into your infrastructure, weaponized in financial markets, and why the next phase is not about price targets on a chart. It's about availability. Stage 1, when silver stopped being owing money. For most of recorded history, silver was not a speculative asset. It was the system. Roman denarii, Spanish pieces of 8, Mexican pesos, US silver dollars, China's silver taels. For centuries, silver coins were how ordinary people interacted with money in daily life. Gold sat in vaults and royal treasures. Silver paid wages, bought bread, settled rent. That world ended astonishingly fast. In the 20th century, one government after another quietly severed the link between their currencies and real metal. In the United States, this happened in 2 big waves. The first was gradual debasement. Laws like the Coinage Act of 1853 lowered the silver content of circulating coins as the bullion value rose toward and above face value. It was sold as a technical adjustment, a way to stabilize the coinage system. But in reality, it was the first systematic step away from bimetallic money and toward an abstract paper standard. Wikipedia. The second wave was explicit removal. By the 1960s, silver in US coins was worth too much relative to the face value. People were hoarding and melting coins. Instead of admitting that their currency had been silently devalued, policymakers blamed shortages and passed the Coinage Act of 1965. That law eliminated silver from circulating dimes and quarters entirely and reduced the silver content of half dollars before later removing it from those as well. At the same time, the Treasury stopped honoring silver certificates with real silver. First, redemptions shifted from silver dollars to bullion. Then, by 1968, redemption in silver ceased altogether. Wikipedia +1. On paper, nothing changed. The pieces of paper still said $1. The coins were still called dimes and quarters. Your paycheck still had the same number on it. But the underlying collateral disappeared. What had been a claim on a scarce mined, finite metal became a claim on whatever the government said it was, backed by debt, taxes, and trust. This was the first silver lockdown, the monetary lockdown. Silver was quietly confiscated from the monetary system itself, not by marching troops, but by legislation and indifference. Coins were diluted and then stripped of silver altogether. Certificates were canceled. Treasury stockpiles, hundreds of millions of ounces, were drained and sold. Most people never noticed. They still haven't. Stage 2, the age of suppression and the Hunt brothers' lesson. Once silver was pushed out of the official monetary system, something strange happened. Instead of fading into irrelevance, it became dangerous to the people running that system. Because once your currency is pure paper, any metal that exposes its weakness is a threat. In the 1970s, that threat came to life. Inflation raged. Trust in paper eroded. Gold and silver began to rise as the world sensed that the promises were being stretched too far. Enter the Hunt brothers. In 1979, Texas oil billionaires Nelson Bunker Hunt and William Herbert Hunt decided to protect their fortune from inflation by buying silver. Lots of silver. Between physical metal and futures contracts, they accumulated a position so large that, at one point, they were estimated to control over 100 million ounces of silver, plus additional futures claims. Wikipedia +1. Silver exploded from around $6 an ounce at the start of 1979 to nearly $50 by January 1980, a 700% move in a year. On COMEX, futures briefly spiked even higher. On the street, ordinary people lined up at coin shops to sell Grandma AS silverware and old coins for prices that felt insane. Then the rules changed. Exchanges hiked margin requirements. New buying was restricted. Some contracts could only be liquidated, not opened. The liquidity rug was pulled at precisely the moment when the Hunts and everyone who followed them needed it most. On March 27, 1980, Silver Thursday, prices collapsed in spectacular fashion, triggering margin calls and panic across the market. The mainstream narrative hardened. See, speculators tried to corner the silver market and got what they deserved. Silver is too volatile. Don't play with it. But beneath that moral lesson was another message. When private capital tries to seriously challenge the paper money regime with physical metal, the referee steps in. Fast forward a few decades, and the same pattern shows up in a more sophisticated form. From the 2000s through the 2010s, large bullion banks, including JP Morgan, dominated trading in gold and silver futures. In 2020, U.S. regulators concluded a multi-year investigation into spoofing in precious metals markets. Traders placed large orders they never intended to execute in order to move prices, then profited from the manipulated moves. JP Morgan admitted wrongdoing and paid over $920 million in combined penalties and restitution, the largest spoofing case on record. Think about that. First, silver was removed from your coins. Then, the price of what remained was largely dictated in a digital casino where the players caught cheating paid a fine roughly equivalent to a rounding error on their balance sheet. You don't need to believe in grand conspiracies to see the pattern. You just need to understand incentives. If governments need trust in paper and big banks profit from volatility and leverage, neither group wants silver to be widely understood as the ultimate no counterparty asset. They don't want a repeat of the Hunt episode on a global scale, so silver spends decades as a suppressed asset, useful enough to keep around and convenient enough to keep under control until something else changes. Stage 3, the industrial chains. While the monetary and financial system were busy playing games with silver on screens, the physical world quietly discovered something unavoidable. Silver is industrial glue. It's not just poor man's gold. It's electricity's favorite metal. It has the highest electrical conductivity of any metal, excellent thermal conductivity, and antimicrobial properties. Once you start building a world out of electronics, networked devices, clean energy, and miniaturized tech, silver stops being optional. Industrial demand for silver hasn't just grown. It has hit record after record. According to the Silver Institute, industrial silver demand reached roughly 680 million ounces in 2024, the fourth consecutive yearly high, driven by grid infrastructure, electric vehicles, and especially photovoltaic solar applications. Solar is the killer app. The paste used to print conductive lines on solar cells is majority silver, often 60-90% by mass. Over 85% of silver paste demand now comes from the solar industry, and solar alone accounted for around 19% of global silver demand in 2024, a share that continues to rise. Zoom out, and total physical silver demand hit roughly 1.2 billion ounces in 2024, with projections that ongoing solar build-out could add up to 150 million ounces of extra annual demand by 2030, from just one industrial segment. At the same time, mine supply is not exploding to match. Silver is mostly produced as a byproduct of mining other metals like lead, zinc, and copper. If those industries aren't ramping up, silver doesn't magically appear. Analysts now talk openly about multi-year structural deficits, demand consistently exceeding new supply, plus recycling. This is the second silver lockdown, the industrial lockdown. Every new gigawatt of solar capacity, every new wave of EVs, 5G networks, AI-stuffed consumer electronics, all of it quietly welds more silver into places it will never come back from economically. Once that ounce of silver is vapor deposited on a solar cell or buried in a PCB somewhere in a landfill, it might as well be on Mars. The metal still exists, of course, but the cost and complexity of recovering it is so high that, in practice, it's gone. Think about the tension this creates. On one side, you have a legacy monetary system that has tried to push silver out of public consciousness as money. On the other side, you have a 21st century industrial system that is chaining itself to silver as a critical input. In between sits a relatively small, highly leveraged financial market that pretends these two realities can be balanced indefinitely with futures contracts and ETF shares. That balance is starting to crack. Stage 4, rationing, allocation, and temporary shortages. If you want to see a lockdown coming, watch what happens at the edges of the system when stress hits. Silver has already given us previews. In 2008-2010, during the global financial crisis, demand for American Silver Eagle bullion coins surged so hard that the U.S. Mint had to suspend sales, ration supply to dealers, and prioritize bullion over collectible proofs. The law technically requires the mint to strike enough coins to meet demand, but physical constraints, blank supply, mint capacity, forced rationing. It happened again. In January 2013, the Mint ran out of Silver Eagle bullion coins and suspended sales after just 2 weeks, overwhelmed by investor demand. Sales resumed later under an allocation program, a polite word for you can get as many as you want. In 2014 and 2015, unprecedented demand once more led to rationing and a temporary suspension of sales while the Mint replenished inventory. Authorized purchasers were told they couldn't order freely. They'd get whatever slice of production the Mint allocated. In 2020, the pandemic added another layer. The West Point Mint temporarily shut down. Production of Silver Eagles was suspended twice. Inventory ran out, and sales had to be halted and then resumed on an allocated basis. These weren't apocalyptic events. You could still buy silver, at a price, with delays, with higher premiums, but they were early tremors. At the same time, the first half of the 2020s has seen silver quietly outperform gold in several bursts. From late 2023 into 2025, silver rallied hard, breaking above $35, then pushing through its old 1980-2011 highs, and briefly trading above $50 an ounce again, driven by strong industrial demand and a chronic supply deficit. The Times of India plus 4 Reuters. For 4 Reuters, plus 4. Each of these spikes produced the same pattern at the retail and semi-wholesale level. Dealers ran low on inventory. Premiums over spot blew out. Mints rationed or temporarily suspended certain products. People who waited until later discovered that later came with conditions. This is the third silver lockdown, the retail lockdown. On a chart, silver looks volatile, dramatic, even speculative. On the ground, what people feel isn't just volatility, it's scarcity. You see headlines like Mint runs out of 2013 silver coin, Silver Eagles temporarily suspended, silver bullion on allocation. You hear from dealers about 6 to 10-week delivery windows when volatility spikes. You see industrial users tightening specifications, pushing for thriftier designs, not because they suddenly care about efficiency, but because the metal they rely on is getting harder to source on predictable terms. None of this is the final crisis. It's the dress rehearsal. Stage 5, the paper claim crisis. So far, the system has muddled through. Shortages have been localized, rationing has been temporary, futures markets have continued to function, ETFs have continued to issue and redeem shares. What happens when those three worlds, monetary history, industrial reality, financial leverage, collide at full scale? To answer that, you have to understand how much of silver is not silver at all, but claims on silver. When you look at a chart quote for silver, you are usually looking at the price of a futures contract on an exchange like COMEX, or the price per share of an exchange-traded product that holds silver in large bar form with a small group of custodians. That system assumes a few things. That people will mostly settle in cash, not stand for delivery. That industrial users can source metal through their usual channels without disruption. That investors who want physical will accept delays and premiums rather than forcing large-scale conversions from paper to metal. As long as those assumptions hold, the number of paper claims can greatly exceed the amount of immediately deliverable metal. The leverage can remain hidden. But in a world where industrial demand is setting new records every year, supply is constrained and projected to tighten further, investors are increasingly nervous about inflation, debt, and currency credibility. It doesn't take a conspiracy for the math to break. It just takes mistrust. Mistrust in the ability of mints to keep up with demand. Mistrust in the ability of futures markets to deliver metal during stress. Mistrust in the long-term value of fiat savings versus scarce, indestructible assets. Imagine a spike in silver similar to the recent run above $50, but deeper and longer. Industrial users, worried about future availability, start building strategic inventories instead of trusting just-in-time deliveries. Refiners prioritize long-term industrial contracts over retail coins and bars. ETFs face large net redemptions from holders who want allocated, serial-numbered bars rather than pooled exposure. Futures traders, scarred by past episodes and by scandals like spoofing fines, begin to doubt that the paper market will behave as advertised when push comes to shove. Nobody has to yell default. The system just slowly shifts from easy paper claims to harder claims on real metal, and every step in that shift tightens the noose on available supply. That's what a paper claim crisis looks like. Not necessarily a dramatic default on TV, but a creeping recognition that the number on the screen isn't a guarantee. It is an opinion that only matters if someone is willing and able to hand you metal at that price. At some point, the marginal ounce refuses to move. Not at any price, but not at a price that makes sense in the current mental model. The bid-ask spread widens. Premiums decouple from spot. Wholesalers whisper about delayed shipments. Mints quietly prioritize some customers over others. And regular people meet a new reality. You can want silver, you can pay for silver, and still not get it in the time frame, quantity, or form you expected. That's the fourth silver lockdown. The claim lockdown. Stage 6, the reset. Nobody plans. For every system has a breaking point. Currencies reach it when people no longer believe that printed promises can hold their value. Revolutions reach it when people no longer believe the system can reform itself. Commodity markets reach it when the stories people tell about supply and demand are no longer compatible with what actually exists in warehouses, vaults, and ground. Silver is approaching that point. Over the last century, you can trace a straight line from silver coins to clad coins and paper, from silver certificates to irredeemable notes, from monetary metal to industrial input, from physical bullion markets to heavily intermediated paper markets, from small local shortages to repeated global rationing events and record-breaking price spikes tied to industrial demand and structural deficits. Each step has pulled silver further away from everyday awareness while making the system more dependent on it. Governments don't like that dependence because it constrains their monetary flexibility. Industries don't like that dependence because it threatens their supply chains. Financial institutions don't like that dependence because it exposes how leveraged and fragile the price really is. Ordinary people, meanwhile, are stuck in the middle, using products that rely on silver, holding currencies that abandon silver, investing in markets whose behavior around silver they do not control or fully understand. So what does a reset look like? It probably doesn't look like a Hollywood script where every exchange shuts down overnight and people trade coins in back alleys for food. That's entertaining, not realistic. A more plausible path is quieter and more brutal. Volatility continues to increase. Silver goes from $20 to $30 to $50, back to $35, then spikes to levels that make today's prices look quaint. Each spike leaves a scar. Another round of mint suspensions, another wave of allocation, another group of industrial users forced to pay up or redesign products. Governments and regulators respond with rules, position limits, higher margins, maybe talk of windfall taxes or restrictions under the banner of stability or climate priorities. The public slowly realizes that the cheap metal that used to be an afterthought is now a strategic resource. At some point, the narrative flips. Silver is no longer framed as a speculative side bet for retail stackers and a playground for spoofing algorithms, but as a national security commodity tied to energy, technology, and infrastructure. Once that happens, the idea that you, as an individual, can freely buy unlimited quantities of it at low premiums for as long as you like becomes optimistic at best. Remember how, in 1918, the Pittman Act authorized melting hundreds of millions of silver dollars into bullion, much of it sold overseas, altering the composition of America's silver holdings with a few signatures? History doesn't repeat exactly, but it rhymes. The tools to redirect silver through taxes, export controls, procurement programs, green mandates, wartime authorities already exist. They don't have to be used to be relevant. Their mere existence is enough to change incentives. For most people, the silver lockdown won't arrive as a single dramatic announcement. It will arrive as another news story that the mint is suspending or rationing bullion coins temporarily, another year where industrial demand hits a record and supply disappoints, another spike where silver briefly breaks the news cycle, then disappears again, leaving higher base prices and deeper mistrust. By the time it feels permanent, the pattern will have already played out. What this really means, and what it doesn't, it's tempting to reduce all of this to a simple slogan, silver to the moon. That's not what this is. This isn't fortune-telling, it's pattern recognition. Government systematically removed silver from your money and from formal redemption channels. Financial institutions turned the remaining monetary and investment demand into a highly leveraged paper game that has already produced scandals and fines. Industry quietly rewired the global economy so that a rising share of silver ends up in forms that are not recyclable at scale. Retail markets and mints have already experienced repeated periods of rationing and suspension when stress hits. Prices, deficits, and demand trends are now signaling that silver is shifting from cheap, abundant metal nobody watches to strategic bottleneck that too many systems rely on. None of this guarantees a specific price by a specific date. Markets are messy. Cycles overshoot and undershoot. Policy changes can buy time, change incentives, or create new distortions. What it does suggest is that the direction of travel is clear. From availability to scarcity, from optional to essential, from ignored to contested. Silver is not just a line on a chart. It's a ledger of broken monetary promises, an X-ray of industrial dependence, and a stress test of financial honesty. If you understand that, you understand why the phrase silver lockdown is not hyperbole. It is a safe description of a system that has already spent 50 years quietly closing the doors on real metal while pretending nothing important has changed. And it's a reminder that in every major monetary reset, the people who suffer most are the ones who trusted that those doors would always stay open.